G'day Geoff, thanks for joining us on the KGB interrogation.
Thank you.
It seems to me, on my reading of the remuneration report, that you and your management team might be in line for some LTI after the huge rise in One Steel's share price over recent weeks. Would that be right? It looks like it's you need to be 50% of the ASX 200 over a period of time, and you've got into that territory.
No, I think we're still a fair way underwater. I think our interests are very closely aligned to our shareholders' interests, and we've still got a significant way to go to be realising some value for them and for ourselves. So I think it's a good example of where the LTIs, should they deliver, will be working as intended. So we still need to improve our share price before myself or my colleagues will get some benefit from where we're at, but certainly a much better trajectory than where it's been.
Where do you need to get it to?
It depends on the years where they were issued, but we're still probably 50 cents short of the most recent issue, so considerable work for me and the team to do yet.
Do you think you'll get there? You've got obviously you've got momentum now thanks to the switch in your business from just steel focusing more on iron ore. Are you feeling confident that you're going to get to that sort of level?
I think a number of people commented that at this half-year results, the company and myself were far more confident than we'd been over the last several reporting seasons, and that's certainly true. I think there's several aspects where we feel much more comfortable. A key matter was being able to forecast that the steel business would return to EBITDA positive, which is addressing one of the sort of downside risks. But the real positives, I guess, were delivering on the improvement out of the mining consumables business, which was in line with the company's expectations, but I think ahead of the market's expectations, so that was very pleasing. And since we reported in August, we've been able to flesh out our growth plans with the iron ore business, and really within 12 months from now we'll have an iron ore business which will be just short of twice the size of our current business at 11 million tonnes. So certainly feel far more positive about the outlook over the next year or two.
Geoff, you've announced that you're going to change the name of the company. Is there a sense of frustration that there are some in the market who still see you primarily as a steel company?
Yes, there is. I think it's the market. It's also often the other stakeholders, the media, politicians and so on, see us just as a steel company. And at the end of the day, that's really a significant impediment to our investors and potential investors. There's a large pool of potential investors who really don't look at us, and even the experience over the last week or two, people are saying, gee, I didn't understand that you were already so significant in mining, or didn't understand you had such a significant mining consumables business. We thought, you were only an Australian domestic long product steel company, which is what we were 4 years ago.
You reviewed the future of that steel division and remain committed to it. Is that because of the cost of remediation, or do you think there is potential for it to be acceptably profitable?
Yeah, that's a key question. I guess there's two stages to that answer. The first one is we've indicated we're confident we can get that business back to generating cash, and to exit that business would take a significant cash investment. So I guess my view is, why would you pay a lot of cash to get out of a business that can generate cash? That's the nearer term objective, to be cash generating. Then beyond that, what we have to do is actually make sure we're generating EBIT returns and generating some value for shareholders. From where we're at, that's a little further out, but the near-term objective is to make sure we don't repeat the recent results and have significant EBIT losses and actually consume cash. And we were quite pleased to be able to say, well, this half we've given some very clear guidance. We expect to be EBITDA positive for the steel manufacturing business in the June half.
If the dollar stays where it is, is it conceivable that Whyalla could be competitive?
I think it is conceivable. Perhaps a way to look at the steel manufacturing is, if we were talking 2 years ago or 3 years ago and I said we were going to have our steel manufacturing business EBITDA positive in an environment where firstly we still have very weak markets domestically, residential and non-residential construction manufacturing is still well below what I would call the normal levels of the sort of 2005 to 7 period, so still very weak domestic markets. But more particularly, I guess, if back in 2008-9 I said I think we can be EBITDA positive with the dollar above parity, I think people would have raised their eyebrows and said, really? So I think it shows just how much traction we've been able to get in improving the steel manufacturing business, of which Whyalla is clearly a key part.
Does Whyalla require a lot of, longer term, does it require a lot of investment to make it well competitive?
No, we don't have a significant CapEx spend there. One of the key things that will improve Whyalla's performance going forward is that we repaired the blast furnace last year, and we now have a blast furnace that's in good condition, operating well, and we'd expect it to be in good condition out to at least the end of this decade. So we can run our steel manufacturing business well below depreciation levels, and I think stay in business CapEx is probably much closer to sort of half of depreciation. So we can run that and continue to offset costs, which is what we've done for a long time. The real issue at the moment has been battling the run up in the dollar.
In terms of what you did at Whyalla, what action are you most proud of in terms of improving efficiency?
I really think there's a lot of people who were looking, Alan, for a single stroke. I think what you're seeing is the cumulative effort of lots of actions by lots of people, both our managers but also our workforce, who understand that these are difficult times and we have to adapt and change. So it's more lots of smaller, sometimes larger changes and initiatives that have occurred. And one of the good things about our people is they do need to understand the ongoing need to adapt and change, and dare I say it, innovate. People trot out the innovate word as the answer to everything, but we've been innovating now for a long time.
Is there any signs of improvement in the structural steel market in Australia? And are you getting much business from the mining investment projects?
We're seeing some signs. We've indicated that this half we expect our steel volumes to grow by about 5%, and all of that will come through what we call engineering construction, which is driven by either infrastructure or resource projects. So we are starting to see some work flow from the resource investment, but at this stage it's only generating a small lift, but we can see over the next year or two there certainly is a more positive outlook in that space, but we really need to see that spill over into investment into non-residential and residential construction as well.
Geoff, can you tell us a bit about what growth you expect from mining consumables? And as part of the answer, perhaps you could tell us what your market share is, how competitive that business is, and where do you think that market is heading to for you?
Happy to talk about mining consumables. We're very positive. Some people don't understand that when we bought the Molycop business, which was the largest grinding media business in the world, we were actually the second largest grinding media business in the world. So I think some people missed how significant we were in grinding media. So that was in Australia, Indonesia and in the US. The businesses we bought were South America, Chile and Peru in particular, but also Mexico and Canada. So we now have generally more than 50% market share in Canada, the US, Mexico, Chile, Peru, significant positions in Brazil, more than 50% of the Australian and the Indonesian markets. So we're very well represented in not just significant markets, but particularly in the case of South America, growing markets. And these are very mission critical products to the mining houses. If the grinding media doesn't perform, their concentrator circuits don't perform and they don't achieve the throughputs that they need for their products, particularly in commodities like copper and gold. So we have a superior technical product, we believe, certainly a superior value proposition in terms of supply chain and logistics, supporting mines in some pretty remote locations. And we now have the added benefit of scale. So this year we'd expect that business to do not far under 1 million tonnes. So it's a business with a lot more scale than people realise.
What do you make the stuff from?
The feed is steel bars, but it's not a steel business. It's a mining consumables business with steel as an input. Part of the know-how is knowing what sort of bars to buy and the unique aspects of the chemistry for the different applications. But there's other technical tricks in terms of particularly the heat treating regime to get the properties you need in the product.
So is this potentially more of a more profitable business than mining for you?
Well, I think it's certainly going to be a worthwhile part of our portfolio. I think the iron ore mining part of our business will continue to dominate, given that in a year or a year and a half's time we'll be at 11 million tonnes of sales of iron ore. But the mining consumables business we'd expect to have growth rate of 10% per annum annualised over the next 3 to 5 years in both North and South America. So it's going to grow pretty rapidly, and a large part of that is growth that's already locked in terms of the significant mining projects that are coming online and underway or being constructed, again, particularly Chile and Peru, but also in the North Americas.
Is consumables a more defensive kind of play than iron ore? I.e., is it more sensitive to volume than price in the resource sector?
I wouldn't describe it as a defensive play. I think what it is less volatile in terms of earnings and margin. It's a more stable play in that context, but it's certainly a growth business. I mean, defensive sounds like it's ex-growth, but we invested in that business on our knowledge of the markets and our very high belief in the growth profile. And having now had a year under our belts, we're more confident than ever that the growth in those markets is there, and we're very confident that we'll get at least our share, and that will make that a very significant and worthwhile business.
You're in a unique position because you are both producing iron ore and you're supplying miners of all different sorts around the world. Do you think we're going to see a big rise in the supply of mineral products in the next 2 or 3 years? And might that affect the price levels that we've been used to?
I think the demand for commodities, in my view, will continue to grow strongly. The people I think China will continue to drive that, but it's not just China, it's the other BRIC and non-first world countries which have still got pretty strong growth rates. In my mind, the concerns or fears about China in particular slowing down, I think, are now overstated. The law of large numbers is such that, even if China only grows at sort of 5 or 6% per annum, in absolute terms, that's the same total growth as it would have been 3 or 4 years ago when it was 8 or 9% GDP growth, just because it's the scale of the economy now. So I see the demand for commodities growing. I think in terms of mining consumables and supporting that will grow to support it, and that's one of the areas we focused on, mining consumables, but we have other products like mining ropes where Australia really has a lot of know-how about mining and mining services, and it's certainly something that is exportable or relocatable, because often the mining houses we're dealing with in Australia, the same people are operating, be it in South America or North America or Indonesia, or in the future I think in places like Africa.
Geoff, you referred to the near doubling in your iron ore output. Iron ore prices have come off a little bit. Where do you sit on the cost curve?
We're confident that we'll be able to maintain that business. So our pre-existing iron ore business at the Middleback Ranges, we've guided to about $50 loaded cost for this financial year. So I think that still puts us in a pretty reasonable position. We're growing through, we acquired Western Plains iron ore business up near Coober Pedy. Some people have missed one aspect of that. It will be higher in the cost curve. We've said about $70 a tonne to get that loaded, but it's a 63% FE, so we're confident that it will be able to support the higher loaded cost. But in particular, what people hadn't understood in the iron ore space was prior to this results, they hadn't understood that we have a unique ability to combine what was going to be a little over 3 million tonnes that Western Plains were hoping to export. We can combine that 63% material with 53% product from our existing mines and make a very marketable 60% FE product, and basically we're able to sell 2 million tonnes more. So we go from a little over 3 million tonnes to 5 million tonnes, and we do it by using product that was either going to be waste or it was going to be questionable when it was going to be used as feed through a beneficiation process. So we can get that product to market quickly and cheaply, and we've made really 3 million tonnes go into 5 million tonnes through the unique opportunity we had through our port infrastructure, but the ore we have in Whyalla that we previously couldn't get to market.
Is one of the benefits of retaining that sort of vertically integrated structure, even though you're tilted towards iron ore, the fact that if prices do come off, you're a beneficiary in the steel business anyway?
I think the integrated model now in the steel side of things is certainly accepted as better, and you know, it's not just the iron ore, it's the fact that we have integration into the downstream markets in Australia, where we're the largest distributor of steel and certainly have the largest reinforcing businesses, and I'd expect we'd see the reinforcing businesses in particular are starting to benefit from the engineering and resources work that's coming through. But what that does is give us a lot more confidence around a competitive position in the steel manufacturing business. So the integration we have both upstream and downstream is somewhat unique, and as disappointing as the steel results have been, you know, I think they're better than they would have been, and certainly a lot better than many others have been who haven't had the benefits of that integration.
Hey Geoff, how do you think Australia's being run at the moment? I'm actually looking for a sort of a comment about the net. On the one side we've got the carbon tax, minerals resource tax, changes to the Fair Work Australia laws, but on the other hand, you know, the economy's going okay, and the government seems to be preparing to go back into surplus on its own budget. So how do you net that out?
I'm probably in the camp of most people who, you know, the barbecue talk, if I could put it, would be, I think most people think we're wasting an opportunity. I think most people understand that much of our current performance is actually good luck, and that could disappear quickly. And I think the extent to which the economy is going well is pretty tenuous, and I think, to me, unemployment's an indicator of that. The issue driving the economy in lots of ways at the moment, in my mind, is not the unemployment level, but the fear of unemployment. And you know, I think that's why we've got saving rates approaching 10%, and that's what's weighing very heavily on you know, residential construction or retail or domestic tourism or a range of things like that. So you know, I think the fear of unemployment is probably ahead of the current unemployment levels, and I guess the question is, well, why do people have that fear? Yes, there's some benefits that come from it, and in terms of you know, the economic bureaucrats would talk about households restoring their balance sheets, but I think it's reflecting an underlying fear and concern where people have either had earnings cut back through no overtime or things like that, or they know people have lost their jobs and they're fearful for themselves. So I think people understand that much of our performance at the moment is through good luck on external factors, and that it could change. So I think that's the core of the issue.
Do you think the government should drop the carbon tax?
I think I've been clear for a long time. I think Australia was getting ahead of the world in the carbon tax. We did a lot of work as a steel industry, and ended up, I think, with a satisfactory approach where the government recognised the specific circumstances of the steel industry and had a sectoral approach. So, I commend them for that. But on balance, I think we're certainly moving ahead of the rest of the world. And if you have a look at what happened post Copenhagen, we expected the US and a number of other countries to move. They've probably gone further away rather than closer to the carbon tax.
Do you think that One Steel is a takeover target?
I think the best thing I can do is make sure that the value proposition to investors is understood, and I guess I'm pleased this half that that's starting to show through in terms of we're now only 12 months away from having an iron ore business twice the size, and we're only within this half, we'll have our steel business back to EBITDA positive. People can see the growth in the mining consumables business. I don't think the value inherent in those things is yet fully understood, but I think people are starting to understand and realise those things. And you asked a question earlier about the name change. Part of the point of saying we were going to change our name but not announcing the new name was to get people to pause and reflect on, gee, this is a different company to what I thought it was or what it was 3 or 4 years ago, and is the value inherent in the company really understood? So part of my job is to get out there and make sure that's better understood. And at the moment, I think that people are only just coming to grips with the inherent value in the changes we've made over the last 3 or 4 years.
In about 2 years, you'll have a big cash flow, if all going well. Do you have any long-term plans to spend it, or are you going to give it back to shareholders?
At the moment, the focus is to apply that to our debt levels. I'd certainly prefer to have debt levels below where they are at the moment. But we've got a pretty good history, I think, of managing our cash flow and managing our balance sheet, applying the cash flow to the balance sheet. It's something the board certainly spends a lot of time focused on and takes very seriously. So, if in 2 years' time the cash flow comes on in line with what most people would expect, I think we have a great opportunity in that regard.
We'll have to leave it there, Geoff. Thanks very much.
Thank you, Geoff.
Okay, thanks for your time.